everyone, and welcome to Jason's in the House. I'm your host, Jason Parisella, and I'm a real estate agent with Keller Williams Realty at the Cumming Center in Beverly. Our host today is Patty Gabriel. She's with Metro Cities Mortgage, which is also in Beverly. And we want to welcome Patty to our show, and it's a pleasure to have you here.
Thank you for having me.
So why don't we start, and just why don't you tell us a little bit about yourself?
Sure. I'm a senior loan officer for Metro Cities Mortgage. I've been in banking for the last 22 years, and I've spent the last 12 years as a senior loan officer.
Oh, great. So now, who did you work for before Metro Cities?
Prior to Metro Cities, I was with Wells Fargo for a couple of years, but most of my career was spent with Andover Bank, when there was still an Andover Bank, for about 13 years.
Oh, okay. So you've been in the industry quite a while.
I have. I spent the first 10 years in loss mitigation with foreclosures and workouts and bankruptcies, and then became a loan officer about 12 years ago.
Okay, so when you started, there was a lot of foreclosures, and basically what's happening now was happening 13 years ago.
Right. When I started in this business, it was the late 80s and early 90s. Pretty similar to the market that we're in right now, with lots of foreclosures, lots of workouts.
Yeah, that type of stuff. Now, are you getting involved with that now, or are you?
I'm involved in that to the extent where I can counsel homeowners on how to handle a short sale, how to save their credit, what to do if they get into trouble, how to work with their lenders to keep their house and to keep paying their payments.
Okay. Now, there's so much to talk about. You hear so much on the news today about the mortgage industry and the banks, and this one's going out of business, that one's having trouble. So let's talk about a little. You mentioned short sales.
Right.
So just so everyone's clear, now what is a short sale?
A short sale is selling your property for what it's worth as opposed to what you owe on it. Your mortgage, for example, could be $200,000, but your property may only be worth $150,000. What do you do if you can no longer afford the payments and you can't sell it and pay the bank the full amount that you owe? You do a short sale. You sell it for what it's worth.
Okay.
And work with your lender.
Right.
To decide what's going to happen with the balance of the loan.
Now, it seems easy and straightforward. There must be a lot more to it. You just don't call your bank or your lender and say, hey, I want to do a short sale.
Right. You really can't. There has to be a serious financial hardship. It can't be you just want to move. You don't like the house anymore.
Right.
There has to be some sort of a hardship. Every lender handles this differently in this economy. With the bad press that the big lenders have had lately, they really want to help homeowners. They want to keep them in their house and paying, or they want to get them out of the house and get the property sold without having to foreclose on it. No bank wants to foreclose on somebody. It costs the bank a lot of money between attorneys, auctioneers, advertising. Then they have to pay the back taxes. They have to secure the property, list it with a realtor, then they have to sell it. It's much easier to just let the current owner sell the property and walk away.
I see. So generally, the banks are interested in it because it's going to cost them less money.
True.
And I guess the bottom line is that if you, as the person that owes the money, needs to keep in touch with your bank or your lender, explain what's happening in the situation, and just try to really be in good communication.
Right. Not answering the phone. Not answering the letters, avoiding them. They're not going to go away.
Okay.
They're really not. And you can save your credit. If you work with the lender, you can save your credit in a year or two. You may even be able to buy another house.
Okay.
If you get foreclosed on, that's anywhere from 4 to 7 years
so your
to
credit's
clean up
hurt
your
a
credit.
lot more.
Your credit's hurt a
Okay.
lot more with a foreclosure than it is with a short sale.
So it's good for both people, both parties involved.
Absolutely.
With the short sale.
Yeah.
Okay. So we don't want to start the whole conversation and the whole show with all this negativity.
Right.
Certainly there's a lot of great things going on in the mortgage industry. I just thought it was important to just touch on that. There's so many different terms that we can talk about also. But so, it's still not like there's plenty of
There's so
great
many
things
properties
happening.
available.
Right.
There's so many mortgage programs that are still available. Yes, lenders have tightened up on their guidelines. It's no more getting a mortgage just if you have a pulse. You actually have to have a down payment. You have to have good credit. But there's still some great programs out there. First-time home buyer programs, down payment assistance. Anybody, really, if you know what to do and how to do it, and you put yourself in the right position, can buy a home.
Okay.
The secret is to buy a home that you can afford.
Right. So actually, it's all this is a good thing.
It really is.
Really, because,
mortgage rates
yeah.
is still at almost 40-year lows.
So yeah, and then people generally that were getting mortgages before, maybe they shouldn't have been getting them, but it was so easy to get them that
It
why
was.
wouldn't they?
And you
Right.
can blame the borrowers for buying these houses they couldn't afford, but really there was somebody whispering in their ear.
Right.
There really was. And if you make it that desirable and convince somebody that, yes, you only make this much money, but you really can afford this house, I can make it work for you.
Right.
And especially with some of the terms that were used, some of the language that is used, it can be incredibly confusing for somebody that doesn't know what they're signing. So it's easy to blame the homeowner
Right.
for getting themselves into trouble, but you can't forget that there was somebody helping them get into trouble that should have known better.
Yeah.
And another good thing that's happened is now states are requiring loan officers to be individually licensed.
Mm-hmm.
It used to be you would work for an office and that office would have a license, but anybody could work in that office under that license. Now there's a criminal background check, there's a credit check, and you have to be individually licensed, and you can lose your license for unfair lending practices. So there is a standard that you have to uphold now, and that's a good thing.
So they've tightened that standard.
They
as you
really
mentioned,
have.
So that's good.
There used to be pretty much no standards,
Wow.
and there needs to be accountability. So
I can imagine, yeah.
and I think if there had been more accountability,
Right.
maybe things wouldn't be like they are right now.
Yeah. Now, I hear a lot about FHA.
FHA.
Now it seems as a real estate agent, I didn't hear about it too much last, I don't know, probably 5, 6 years maybe. I didn't hear too much about it. It wasn't really, well, I don't think a lot of borrowers were actually using FHA. Now it seems to be a very popular type of loan.
It really is. Back in 1995, when these different mortgage programs started to become very popular, stated income loans, stated asset loans, things like that, people getting a first mortgage and a second mortgage to avoid mortgage insurance, which is what you have to pay if you put less than 20% down on a property. To avoid all those things, people got away from FHA loans, and they started doing these designer mortgages, we'll call them. Those have gone away. They are no more, and they won't be coming back. FHA is a great program. It allows buyers with as little as 3% down to purchase a home. It gives them great interest rates that are very competitive, and your loan is secured by the government. Another good thing is that there used to be very, very stringent appraisal requirements with the FHA, and credit and income requirements, things like that. But some of those were almost impossible for people to meet. They've loosened up on those requirements and made it a lot easier for more people to have access to the Federal Housing Administration, which is what the FHA is.
Okay. So is it for only first-time buyers?
No.
Or anybody can do FHA?
Anybody can do FHA, absolutely, as long as you're purchasing a primary residence, and you can either do a purchase or a refinance.
Okay.
There's also a new program that FHA has and the federal government has come out with to help people that are in trouble, and it's called an FHA Secure Loan. And it's to help people that are in a mortgage now that they can no longer afford, especially an adjustable rate mortgage where the rates and the terms of the loan have changed and made it impossible for them to afford their monthly payment. FHA Secure is a program that the government put into place to help those people to try to keep them in their home, paying at a reasonable rate. It's basically a refinance of a bad loan.
I was just going to say, so if you're having trouble with the bank, with a short sale, or having them understand to help work with you, you could potentially refinance.
You could.
Through FHA.
You could.
Okay.
You could.
That sounds like a great alternative.
It really is, and it's keeping a lot. Right now, there's 2.2 million homeowners that are delinquent on their mortgage in this country.
Wow.
That's a lot of people that are in trouble and
Yeah.
are in jeopardy of losing their home. The government has stepped in, and there's a new law that's going before Congress right now, which should pass in August, the Homeowner Relief Act, which will help people in more ways. They've passed new rules and regulations as far as what lenders can do that go into effect next year. No more prepayment penalties.
Wow.
You have to prove your income, prove your assets. A loan officer has to prove that the borrower has the ability to repay the loan that they're getting. So they've really tightened up so that people can't get into trouble like they have in the last couple of years.
So if someone is having trouble making the payments,
Mhm.
what's the first thing they should do?
Call their lender.
Call the lender first.
Call their lender first.
Okay.
Absolutely. And their lender can counsel them on what they need to do.
Okay.
But hoping that the bank is going to go away is never a safe bet.
Right.
They're not going to go away.
Right. Okay. Now let's shift gears a little bit. Let's talk about, there's a buyer out there ready to buy a house.
Yep.
And what should they do first?
The first thing they should do is they should get pre-approved for a mortgage. And the one thing I want to clarify is that there is a big difference between a pre-qualification and a pre-approval. A pre-qualification is when you call a bank and you say, I make this much money, I have this much money in the bank, and I want to buy a house that costs this much. They very quickly run a calculation on a calculator and give you a yes or a no. That's all a pre-qualification is. It's really not worth the paper that it's written on. If you want to buy a house and you're serious about buying a house, you need to get pre-approved. That involves providing pay stubs and bank statements to your lender, as well as having your credit pulled, and as well as running the loan by an underwriter or through an automated underwriting system. Fannie Mae has a system called DU, Desktop Underwriting. It's a computer program. You enter the information in. It comes back with a yes or a no. If it comes back with a yes, you're pre-approved.
So when it comes back with a yes, I would assume it's a yes subject to appraisal.
Subject to appraisal,
Okay.
subject to a clear title on the property, subject to a purchase and sale agreement.
Okay. That sounds pretty
That's
clean,
it.
yeah.
Exactly.
So-
And if you get pre-approved up front, you've already done all the hard work as a borrower. You've already provided the pay stubs and the bank statements and the W-2s or the tax returns. All you have to do is sit back, let us appraise the property, do the title work, and
Right.
close.
And I would imagine, too, you have so much more leverage when you're out there making offers on properties. Real estate agents see that you're pre-approved. They see that it's it's a legitimate letter.
Well,
that's
you
been
as
run
a-
through.
right.
So it makes it easy for the real estate agent, too.
You as a real estate agent, I'm sure, would accept an offer from somebody that's already pre-approved as opposed to somebody that hasn't even talked to anybody yet.
Right. Absolutely. So it gives the buyer more leverage.
Much more leverage,
Yeah.
much more buying power.
And I've noticed, too, most of the time, it's very rare now that an agent won't ask. They're always going to ask for a pre-approval letter.
Right.
And they want the real one, not the pre-qualification.
Exactly.
Yeah.
And it's a very quick process. You can do it in a half an hour. Fax the information to the lender, let them pull your credit, let them run the loan through. I mean, you're talking a half an hour to an hour.
Yeah.
And it's very worth it.
So it doesn't take long. It's straightforward.
And it should be free. You should never
So you
pay for pre-approval.
Now, that includes, when you get the pre-approval, it includes the credit check.
It does.
So you're not paying for that either?
You shouldn't be.
Okay.
Most lenders should provide you with your credit report.
So
At
there's
no cost.
there's no upfront fee for an application or anything like that?
No.
Okay,
No.
well, that's good. So people don't need to have to worry about that.
Right. And if there is, you might want to check
Now-
around.
Right. Now, typically, too, isn't it when you order the appraisal is when you would then have to, when's the first time you'd actually have to come up with money that could potentially not come back to you if the transaction doesn't go together?
As far as the lender
On
is
the lender,
concerned,
yes.
with the appraisal.
Okay.
We ask for the appraisal fee up front because we have to do the appraisal up front before the loan is approved.
Right.
We want that appraiser to get paid for his work. So the way Metro Cities does it is we actually have the borrower make the check out directly to the appraiser. We're not collecting any fee up front.
I see.
Each lender is different. Some lenders prefer that they be paid and then they in turn pay the appraiser for their work.
Right.
But that is usually the only money that you should have to pay up front. It used to be very popular for lenders to charge a rate lock fee. Most lenders won't do that anymore. We don't, but I'm not sure about all of them.
Right.
And as far as any other fees that they would have to pay up front, on the lender side, there are none. Most people will pay for a home inspection. A lender does not require it. It's a buyer's choice.
Right. That's a different, yeah. So
That's
the home
totally
inspection
different.
would be something they do on their own.
Exactly.
Okay. Now, when you get this pre-approval letter, how long does that typically, does it expire?
It usually expires within 60 days.
60 days?
And the only reason I say that is because a lot of things can change within 60 days. We want to make sure that somebody hasn't lost their job, they haven't had to spend all the assets they had in their checking and savings accounts, and we may want to rerun their credit after 60 days just to make sure that they have continued to pay any outstanding debt on time.
Okay. So then, a lot of people are always watching the rate They want to make sure they're getting a good rate.
Yep.
At one point, can the borrower lock the rate? At what point do you recommend that they do? How does that all work? And when you do, how long does that last for?
Each rate lock is different. A normal rate lock is usually 30 days.
I thought it was usually, was it 60 or did that change?
Sometimes you get better pricing if you're willing to lock for 30.
Oh, okay.
Your rate might be a little bit different if you lock for 60, and there's usually a fee to pay if you want to lock your rate for longer than 60 days.
I see.
But most rate locks are 30 to 60 days. A borrower can lock their rate. Lenders usually ask them to lock it within up to 5 days before the closing. We need those last 5 days to get the documents out, to finalize our information and get everything where it's supposed to be on time for the closing. But they can lock at any point in the process.
When do you see buyers usually locking? When do you usually see them do that?
If there hasn't been a lot of movement in the market and rates have been pretty steady, people will usually lock at the time of application. If the rates have been going up and down, as they have been recently with everything that's been going on in the media about Fannie Mae and Freddie Mac, people might wait to see if things calm down a little bit and rates come back down again.
I see. So you get your pre-approval.
Mm-hmm.
The application process is when you find the house? Is that how that works? Or you're saying that...
You're pre-approved
Yeah.
and you've started the application process. Once you identify a property and you decide you want to go forward with that lender, that's when the actual loan starts.
Okay, yeah.
The loan process starts. We order the appraisal, we order the title, gather any information that we're missing. The loan is processed, it's reviewed by an underwriter to make sure that everything is the way it should be, and then an approval is issued. And then we just wait for the closing.
Generally, how long does that take? Between the time they find a property and then you finalize on your end with the loan?
We'd like 30 days. We can close a loan in, you can close a loan in 2 weeks if you have to.
Yeah.
It depends on, you'd like longer time for an appraiser or for an attorney to do their due diligence.
Right.
Rushing it through is sometimes how mistakes are made. But if you have to, you have to. There may be mitigating circumstances where somebody needs to move right away.
Right. So generally, a buyer, if they put an offer on a property, they should allow themselves 30
days.
30 days total?
Yep.
Yeah, okay.
From start to finish.
Okay. Yeah, I would imagine, too, that it may take a little bit longer with kind of things have been a little bit in flux and changes and things like that, so it's probably not a bad idea to give yourself a little bit more time.
Right, and especially first-time homebuyers that may be getting down payment assistance from another source, say a local community development office that may be willing to match them dollar for dollar on their down payment. The town may need a little extra time to do their paperwork.
I see.
So rushing that within a 2-week period may prevent them from getting any extra money that they may be able to get from the town.
Okay. Now, let's talk about some recent things that have been in the news.
Sure.
First thing, clarification of the changes in the last 2 weeks regarding Fannie Mae and Freddie Mac. Now, why don't you just briefly explain a little bit about what is Freddie Mac and Fannie Mae?
Okay.
And what's happening with...
Fannie Mae and Freddie Mac are government-secured entities. They are the largest lenders in the United States, basically. They hold 1 out of every 4 mortgages. They account for $5 trillion worth of mortgages, which is 1/6 of our nation's economy. They are guaranteed by the government, which means if they run into trouble, which they actually have not, their stock went down, but Fannie Mae and Freddie Mac are not going anywhere.
So
the government is gone. They're still solid. Yes, their stock went down, but they've had to write off a lot of bad loans. The government has decided that they are going to increase their lines of credit, and if they have to, buy stocks in those companies to make sure that they have the capital they need to keep the economy moving. If Fannie and Freddie ever went out of business, that would stop the entire national housing market in its tracks.
Wow.
So they can't let that happen, and they never would.
Right.
Fannie and Freddie are always going to be there.
Yeah.
There are new oversights to make sure that they have plenty of capital, which they do, and to make sure that they have plenty of credit lines, which they do. I think the government is concerned because a lot of the mortgages that are sold by Fannie and Freddie as mortgage-backed securities on the open market are bought by foreign countries.
Oh, I see.
1 out of 10 American mortgages is owned by some sort of entity outside of the United States.
Wow.
So we want to make sure that the American dollar has weight outside of the United States.
Right.
Therefore, we got to make sure Fannie Mae and Freddie Mac stay strong.
So everything should be, it should all,
It
through the
will.
government's help, everything should be okay with
It
Fannie
will.
Mae and Freddie Mac.
IndyMac had some problems. They've been taken over by the Office of Thrift Supervision, so there is no more old IndyMac.
Mhm.
But the FDIC is going to come in and insure those deposits. Those mortgages are still good. Those people are not going to lose their homes just because IndyMac no longer exists.
So who took over IndyMac?
The Office of Thrift Supervision, basically the FDIC came in and shut them down.
Oh, wow.
They were
So they actually forced them to shut down?
to shut down. What happened was they had published their losses for the year. It caused a panic and it caused a run on the bank, and they were losing $1 million a day in deposits. People were coming in and
Wow.
closing the accounts up to $1 million a day. They couldn't sustain.
So the losing the deposits was the real catalyst for this whole thing. to
They
happen.
lost all
It
their
wasn't that
capital.
There was bad loans.
Well, they had to write off a whole bunch of bad
And
loans.
that's what kind of, okay.
And that's what started the ball rolling. IndyMac was one of the biggest provider of these subprime loans.
Oh, I see.
They did a lot of subprime, they did a lot of stated income loans, no document loans, things like that. A lot of those loans went bad. They had to write them off. And when they did and their stock earnings came out, people panicked and withdrew their money.
Right.
So
Wow.
then the FDIC came in and they're insuring all of the deposits up to $100,000, $200 if you have a joint account. And that's it for IndyMac,
Well,
unfortunately.
Yeah. Interesting.
There are right now about 90 banks on the FDIC's watch list. Will there be other bank closures? Possibly.
Did you think it's basically the ones that are going to go out or already taken
Pretty
care of
much,
it?
pretty
Yeah.
much. Most of the lenders that are going to be balancing their books at the end of the year, July 31st is the end of the year for them. So any losses that have to be written off, they're going to be written off very quickly. Anything that's going to happen will happen in the
Okay.
next couple of weeks.
Now, let me ask you, the process, we don't need to get complicated, but what happens when somebody meets with you and you write a loan?
Mm-hmm.
You package it up.
Mm-hmm.
Now, what happens to that loan after you're done with it? And who does the borrower end up making payments to?
Okay,
And you can use your company as an example.
that's fine.
It's generally, I would imagine, with any mortgage company, this is what the process would be.
Well, we're a direct lender. We're not brokers.
Okay.
I'm
So
a
what's the
banker,
difference
not a
between
broker.
Broker and a direct
Banker
lender?
is somebody that processes, underwrites, closes, and funds their own loan. They have the control of the process from start to finish. They use their own money to make those loans. A broker is somebody that will take an application and kind of put it out to the highest bidder. They'll take the application, but they won't have any control of the process from start to finish. They basically just send it off to whatever bank they decide they're going to have that relationship with, and they lose control of the process from then on. It's in somebody else's hands. The way I do it is once I've taken an application from somebody, it goes to processing and underwriting. Once the loan is approved, it's closed and it's funded. A lot of lenders do not service their own loans. And Metro Cities is an example of that. We do sell our loans once the transaction is complete. None of the terms and conditions of the loan change. The only thing that changes is the address that you make your payment to.
I see.
By selling those loans, we receive more capital to turn around and give loans to other people.
So, in essence, Freddie Mac and Fannie Mae are the two biggest entities that end up buying these loans?
Yes.
Okay.
And they sell them.
That's how they come in?
That's how they come in. And the
Okay.
way they raise money to buy these loans is they turn around and sell the loans in the form of mortgage-backed securities on the market.
I see. It can get very confusing, I
It
can
can.
imagine.
It can.
You've been in the business for a while, so probably
I have.
easy for you. But anyway, what do you think of interest rates? Up, down, where do you think they're going to go?
I think they're going to stay pretty consistent. There haven't been any huge changes recently. I think, if rates are under 7%, we're doing pretty good. We really are, considering the housing market now. Things have slowed down, but rates are very affordable.
So you think it'll stay under 7 for roughly how long?
I wish I could tell you.
I
If
mean,
I knew
you
that. Yeah. I honestly don't know. I wish I could tell you.
I mean,
but
it's been under 7 for so long.
it really has.
Yeah.
The lowest it got was in the low 5s, and that was wonderful. That was great, but how long could we sustain that?
Right.
You know.
Yeah. Now, first-time buyers.
Yes.
Are the programs still available?
Yes, absolutely.
Plenty available so people can still go out and buy houses and get
Absolutely.
loans and yeah.
Massachusetts Housing Finance Agency is a great agency. They allow buyers to finance up to 100% of their property.
Wow. Now, what was the name of that agency?
The Massachusetts Housing Finance Agency.
Okay.
And there are a lot of banks now that can no longer offer 100% financing because of the stricter guidelines that we have to write loans under. Mass Housing, they're also a government-sponsored agency, but they're sponsored not only by the federal government, but also by the state of Massachusetts. They also have their own mortgage insurance, where a lot of mortgage insurance companies now are preventing banks from lending more than a certain amount. As long as you meet their guidelines, Mass Housing will allow you to borrow 100% of the purchase price of your home. And that's a great thing. It's nice to have a down payment, but it's not possible for everybody.
Right.
They do ask you to go through home buyer education classes, which I think are a great idea.
Good. Okay.
But they have very competitive rates, and they make it possible for people that don't have a down payment to still buy a home.
Okay. With just a few minutes left, let's talk a little bit about how does someone find a good loan officer?
Well, it's always good to shop. It's always good to shop. Personally, I prefer bankers over brokers, but that's my personal opinion because I'm a banker.
So why would you say that?
Because they have more of control over the process. They're not trying to make a point up front, a point on the back, more lender fees, things like that. A direct lender or a banker, they have a set rate. That's what they're going to make on the loan, and they know it, and that's it. But I definitely think people should shop around. If anybody asks you to pay money up front for anything other than an appraisal, I would walk away. If they say they can't lock a rate or even quote you a rate until they've pulled your credit report, I would be a little leery. If you are going to have your credit report pulled when you're buying a home, have it pulled once and get a copy of your credit report.
Okay.
The more times it's pulled, the more times your score is affected. And with the guidelines that we have now, anything less than a 720 could affect your interest rate on a credit
score.
score.
You have to be careful how many times you pull your credit.
You really do.
Pulled.
You should definitely shop for rates. You should shop for closing costs. And anybody should be willing, any loan officer should be willing to put everything in writing.
Okay.
They are, in fact, required to give you a good faith estimate.
Okay.
And once that rate is locked, they're required to provide you with proof that that rate's been locked.
Okay.
And the rate can't change.
Good. All right, so if any of our viewers would like to contact you, how would they go about doing that?
I'm at the Metro Cities office at the Cummings Center in Beverly. I can be reached at 978-423-3006.
Great. Well, that was very informative, Patty. We're glad to have you with us again, and we appreciate your time.
Thank you for having me.
Well, before we close, I just want to thank everyone for watching us at Jason's in the House. We certainly hope you've enjoyed the show, and we'd love to see you again at our next show. Also, if you have any comments, questions, actually if you want to be a guest on the show or anything that you want to talk to us about, feel free to give us a call or send us actually visit our website. You can call us at 978-927-6030, or you could also visit us at www.jasonparisellateam.com, and my last name is spelled Parisella. It's www.jasonparisellateam.com. And I look forward to seeing all of you at our next show. Thanks.